Hello and welcome from Quo Vadimus Media Ltd to episode 6 of our free AAT Level 2 Introduction to Bookkeeping video course. Episode 6 today is called Double Entry 1 Basic Principles. It's called Double Entry 1 because there's going to be a number of different double entry episodes, numbered 1, 2, 3, etc., with a subtitle like we have here for Basic Principles, introducing the topic. It's the biggest topic that you will look at level 2, and it is the key topic as well in terms of understanding the content and of course passing the exams. This video course is aimed at anyone who is either studying or who is thinking of studying for the AAT Level 2 certificates in bookkeeping or accounting. And it's for the units Introduction to Bookkeeping and Principles of Bookkeeping Controls. Particularly in these early lessons, we are picking up the key knowledge for Introduction to Bookkeeping, which is the first exam, which you'll then be able to put into practice later on in your studies in Principles of Bookkeeping Controls, which will be the subject of some later lessons. So as mentioned, these double entry episodes are going to be broken up into short episodes looking at particular topics. And first of all, we're going to be looking at basic principles here in this particular lesson, just outlining some of the basic principles and what double entry is, and then starting to get into the nitty-gritty of it in later episodes. So we'll look in this episode at what is double entry, then at what are the basic principles, and that's going to be the key part of this lesson, and then what are some examples. So we'll then finish off this lesson by having a couple of examples to look at which just show it in practice, and then in later lessons we'll build on those examples by seeing more and more double entry at work. So double entry bookkeeping is so called for the following 5 reasons. The first reason, each transaction is usually recorded as a pair of entries. Now you'll notice there I've put an asterisk next to the word usually. That doesn't really matter to us at the moment, but sometimes double entry actually involves 3 entries, and that's because of VAT. In particular, we're not going to look at that in today's episode. We need to look at the basic principles first, and we'll look at those sort of triple entries much later on. But for now, just hold in your brain that each transaction is usually recorded as a pair of entries, which then puts us on to reason 2, which is one of those entries will be in one account, one of those entries will be in another account. Reason 3, whatever 2 accounts are being chosen will be determined by the nature of or reason for the transaction. So, just for example, if the transaction is a payment of rent out of the bank, the 2 accounts are going to be bank and rent. So there's always a logical reason why particular accounts are chosen. It's not random, it's very, very particular. And double entry, as you'll learn as you go through it, is very particular. As we get then to reason 4, one of those 2 accounts will always contain the debit entry, and we'll look a little bit more about what that means in a moment. And one account will always contain the credit entry. So every double entry transaction should generally be a pair of entries, 2 transactions, 2 accounts. One of the accounts will have a debit entry, one of the accounts will have a credit entry. And the key skill that you're learning in particular early on is actually which is which and why. Finally, in terms of reasons, the 2 sides must match and the debit entry must equal the credit entry. That basically means, for example, you may be paying rent of £1,000, and going by the rules of double entry, which we'll begin to look at here, that would involve a debit entry in the rent account for £1,000. For every debit there must be a credit, and it should be equal. So if there's a debit in the rent account for £1,000 and the money's gone out the bank, for example, the other entry will be in the bank account, and that will be a credit for, guess what, same amount, £1,000. That's what reason 5 means from that point of view. And if you can get those 5 reasons, those 5 basic principles, which we'll start to pick up on over the next few lessons, including this lesson, then you'll start to understand what is going on with double entry, which we'll begin to look at now just by looking at an account. Now, there's no entries been made in this account. This is just a blank account to show us. So this is the bank account. So this is the bank account in the general ledger of the double entry bookkeeping, and we'll look more into the general ledger and what that is in the next lesson. But it's a record within the bookkeeping account of the business, which shows what has been going on in the bank for the business as well. It's the business's own record of the bank account. But what we can see here, the most important thing for you to sort of get at the moment, is the account has 2 sides. It has a debit side and it has a credit side. Every general ledger account, every double entry account will have a debit side and it will have a credit side. And that's what we've got here. Debit is quite often shortened to DR. Credit is quite often shortened to CR, and that's partially to do, not completely, but partially to do with their Latin roots from when sort of bookkeeping was first developed. Not going to go too much into giving you a history of the origins of bookkeeping here, because you don't need it for this. If you want that, that is actually available in our basic bookkeeping course as well, but you don't need any of that for AAT, so I am skipping it here. But the main point for you to get here is that every single double entry account has both a debit side and a credit side, and the rules of double entry will determine what side transactions go on, which is what we're going to start looking at next. So there are a number of different ways that students can use to memorize, to learn, to practice, to get used to what normally goes where. Once you get into double entry bookkeeping at level 3, or even to a certain extent in principles of bookkeeping controls, this gets a little bit more complicated, because you may be dealing with errors in level 2, or you may be dealing with end of year adjustments at level 3. But these basic principles, and I'm going to go through 3 methods, all of which are very similar to each other, but with some slight variations, which explain what is going on. So the first method, and this is probably the most common, is called dead click. Dead click, CLIC on click. And the idea is that expense, asset and drawings accounts will normally have a debit balance. And in the case of introduction to bookkeeping, we'll have debit entries, and that's the key thing to hang on to at the moment. So if you are dealing with introduction to bookkeeping within an expense account, for example rent, it will have debit entries. If you are dealing with an asset account, for example, motor vehicles, if a business has bought a vehicle, or a business has bought inventory, or a business has bought fixtures and fittings, these are assets, so they will have debit entries and normally a debit balance. And drawings, which is when a business owner takes money out of the business, will normally have a debit balance as well. There's opposites to these on the credit side. Liabilities, if you've already looked at episode 5, which is on the accounting equation, and if memory serves me right, episodes 3 and 4, which were on assets and liabilities, I will at least have partly introduced the idea that assets and liabilities are opposites. Assets are when you have something of value or when you are owed money. Liabilities are when you owe money. So they're opposites in that sense. They are opposites here as well. Asset accounts will normally have a debit balance, but liability accounts will normally have a credit balance. Income and expenses, also opposites as well. So expenses accounts normally have a debit balance, but income accounts will normally have a credit balance. Then drawings and capital are opposites as well. Drawings is when owners take money out of the business. Capital is when owners put money into the business. Definition of capital is actually a little bit more complicated than that, but that is a useful definition for us to be looking at. at the moment. So capital will normally have a credit balance. So we've got these opposites between debits and credits. In a later episode, we'll look at lists of, a good list of expenses and income, for example. We've already done this with assets and liabilities in the earlier episodes, but a large part of understanding double entry is actually about understanding, well, what is an expense? What is a liability? What is an income? Being able to identify these things. So dead click can be really, really helpful for this. There is a variation of dead click, which is called deep click. The only difference between dead click and deep click is that in deep click, you remove drawings, and instead of drawings, you have purchases. So dead, and the D of the dead, second D from drawings, becomes a P for purchases. Purchases will normally have a debit balance as well. You may be looking at that going, well, aren't expenses and purchases the same thing? In some ways, yes. In some ways, no. Quite often in the language that we use in AAT, not always, it has to be said, but quite often in the language that we use, we actually make a distinction between expenses, purchases, and acquisitions. Expenses are the general running costs of the business. Purchases are when you are buying things like stock and raw materials, etc. Acquisitions are when you are buying assets. And actually, although it's not required to use those distinctions for AAT, it can be helpful just to recognize that they are different and therefore they are treated differently. But if you notice, expenses, assets, purchases all have debit balances. And there's a reason for that. And the reason for that is they all involve spending money. So in terms of double entry and in terms of everything needing to be a debit or a credit, they are all spending money, which is a debit in those accounts, in the bank account, which is the opposite account for those transactions. And we're going to look at the bank account along with the general ledger in the next episode. Then the bank account, money coming out of the bank account, is a credit in the double entry system. But deep click there, exactly the same as dead click. The only variation is we replace the D of drawings for the P of purchases. There is another method as well that sometimes people use, and there are other methods that I've not even covered here. But another one is called PEARLS, which is purchases, expenses, assets, revenue, liabilities, sales. In PEARLS, P, E, and A, purchases, expenses, and assets. And we've seen those in dead click and deep click. They normally have a debit balance. So they have a debit balance, so they sit on the left-hand side. Whereas revenue, liability, and sales, they normally have a credit balance. And we've seen income mentioned in dead click and deep click. And revenue and sales here are just other terms for income. Revenue involves quite complicated parts of income generally, or it can do, as you'll see a little bit later in your studies, but it's still income. So revenue, liabilities, and sales on the credit side, purchases, expenses, assets on the debit side. You'll have noticed for all of these three methods I've put, just using the bottom one there, sales as an example, sales will normally have a credit balance, but may have some transactions on the debit side. Don't for now worry about the sum transactions. They are for particular reasons. Normally, when you make a credit sale or any sale, you'll record it on the credit side of the account. There may be debit entries in the sales account, but they will be for very particular reasons, which we'll look at in later parts of the study around principles of bookkeeping controls in next unit, and eventually in a later course, level 3 as well. We're just keeping it simple for now. Couple of examples just to put into the context of what we've been talking about. And I've already talked about one of these examples, but I did with a slightly different set of numbers. So the business makes a payment of rent of £1,200, and the double entry for this will be rent paid, £1,200, that will be a debit. Bank, £1,200, again the numbers must match. So it'll be a credit. So we can see the reasons here. So rent paid and bank, they are related to the fact that this is a payment of rent out of the bank. So they are the logical accounts. It's £1,200. So that's going to be the amount. There must be a debit. There must be a credit. Rent paid is a debit because rent is an expense. Expense either in dead click, deep click, or pearls normally have debit entries and a debit balance. Bank for £1,200 credit here. I mentioned just a moment ago that money out of the bank is a credit. We're going to look at this a little bit later, but really, presuming that the business has money in the bank, that credit entry is actually the reduction of an asset, which is another reason why it's a credit as well. If you find that a little bit complicated right now, don't worry about that. We'll be looking at that in the next lesson when we look at the bank and the general ledger. But we've basically got the principles of double entry at work in that transaction. Here's another one. The business makes sales of £1,000. This is money coming into the business this time. The double entry for this is going to be bank £1,000 debit, sales £1,000 credit. Again, the two accounts that are relevant to the transaction. The business has received £1,000 into the bank for those sales. And then sales is an income account. So the bank here is a debit account, a debit entry, because the bank, when you have money in the bank, is an asset. So if you are receiving money for sales, for example, you are increasing the asset, so it's a debit entry. Sales, however, is an income account. It's the I of the click in dead click or deep click, and you can edit the S in pearls. But either way, what you're basically looking at for here is the double entry principle in action. The bank is an asset account with a debit entry. Sales is an income account with a credit entry. And as we go through further lessons, we're going to look at more and more of these examples with more and more different types of account as well. So that's the end of this particular lesson, episode 6 now. Do subscribe and like our YouTube videos, as I can see that some people are starting to do, which is great. That helps us to get our message out there fundamentally. You can also visit our website, quovadimusmedia.co.uk, where you can find lots of information and resources. In particular, you can find product pages to all our key books, including our study guide for Introduction to Bookkeeping, which is now on its 2nd edition, as well as for the other books at level 2. So lots of our information there to all of our various publications in print and Kindle. Also, you can follow us on various platforms. Again, it just helps us to get our message out there. You can follow us on X, on Facebook, on Instagram, on Blue Sky, or on LinkedIn. Just search for Quo Vadimus Media Ltd and you'll be able to find us there. And then we'll be able to get to know each other, and you'll be able to get to know our stuff, and more importantly, get better at bookkeeping. So this is the end of this episode 6, and I look forward to seeing you in episode 7, where we'll be looking at the general ledger and we'll be looking at the bank account.